Right now, your personal retirement account is being systematically re-engineered to act as the ultimate institutional exit door. The mainstream media wants you staring blindly at flashing green arrows on a smartphone screen. But behind the heavy velvet curtain, the institutional elite are staring directly into a macroeconomic firestorm. Big tech insiders are already liquidating their personal equity at the fastest velocity seen in a decade. They know what the financial press refuses to print. The newly appointed Federal Reserve Chair wasn't handpicked to rescue your purchasing power or pump your index funds. He was brought in to manage a structural insolvency that has already been locked into place. While retail traders are busy buying the dip, a critical geopolitical choke point has quietly snapped shut in the Middle East, locking the global monetary vault doors from the inside. The exit door is actively welding shut, and the players in bespoke suits are quietly slipping out the back before the entire system goes up in flames. You are not being protected by the system. You are being positioned to absorb its radioactive waste. Strip away the corporate noise and look directly at the plumbing of global trade. A silent maritime stranglehold is tightening around the Strait of Hormuz, transforming a critical economic artery into an absolute black hole for capital. Billions of dollars in crude-heavy transport are stuck dead in the water, sitting ducks on a thermal satellite map, while global energy spot markets experience a systemic cardiac arrest. This isn't a localized political dispute. It is a direct, violent severing of the global industrial baseline. The macro reality is brutal. Core inflation inside the United States is pinned at a sticky, immovable 3.7%, miles above the official central bank target. Real maritime freight costs are exploding overnight, marine insurance premiums are compounding exponentially, and the global economic engine is breathing its own toxic exhaust. When the cost of moving a physical container across an ocean triples in a single financial quarter, the corporate balance sheets you rely on for your stock valuations become completely fictional. The consumer base is maxed out on credit, corporate margins are compressing, and the raw input costs of the modern economy are expanding at an unsustainable rate. To understand how we got trapped here, look at the central bank through a lens of absolute cynicism. Think of the Federal Reserve like an exclusive high-end nightclub that decides to hire a hyper-easygoing bouncer whose sole mandate is to let every broke college kid pass the velvet rope and hand out free drink vouchers until sunrise. For a brief historical window, the party looks incredible, but the exact second he clocks in for his shift, the kitchen catches fire, the water mains burst, and the structural pillars of the building begin to buckle under the weight of the crowd. Instead of passing out free champagne, he's forced to slam the heavy iron fire exits shut, call the riot police, and start charging $50 for a single plastic cup of lukewarm tap water. That is the exact reality Kevin Warsh is facing as he steps into his leadership role at the central bank. He inherited a macroeconomic crime scene. He took the job expecting to play the monetary hero, print cheap liquidity, and receive a standing ovation from Wall Street. Instead, a structural energy shock just flipped the script, forcing him to act as the ultimate economic executioner. The retail crowd is still blindly buying tech stocks, treating a structural floor collapse like a temporary speed bump on the road to endless paper wealth. This is pure mathematical denial. Sticky core inflation means every single anticipated interest rate cut, dangled by the media for the past 12 months, is completely dead on arrival. Behind closed doors, fixed income desks are quietly awakening to an absolute nightmare scenario. The upcoming June Federal Reserve meeting isn't going to bring the monetary relief the market has already priced in. Instead, institutional swaps and credit markets are violently repricing for an aggressive, unannounced interest rate hike designed to halt a secondary inflationary spiral before it triggers a sovereign debt crisis. While the corporate press continues to flash bright green numbers on television monitors to keep the public calm, the multi-trillion-dollar sovereign bond market is actively breaking apart. The yield curve isn't just inverted, it is becoming completely disconnected from fiscal reality. When the risk-free rate of return resets higher in a debt-saturated economy, every over-leveraged corporation in the S&P 500 faces an immediate structural contraction. Listen closely to the public statements issued by Silicon Valley executives over the past 48 hours. We remain completely confident in our long-term capital allocation strategy to maximize shareholder value through dynamic equity adjustments during this period of macroeconomic transition. Let me translate that polished corporate speak into plain, brutal English. They are turning on a multi-billion-dollar industrial vacuum cleaner to suck the remaining liquidity straight out of your retirement account before the broader market hits a concrete wall. Look directly at the regulatory filings. Meta is already quietly laying the operational groundwork for a massive, multi-billion-dollar secondary stock issuance. Think about the sheer audacity of this maneuver. They aren't executing stock buybacks because they believe their company is undervalued. They are actively minting tens of billions of dollars in new paper shares to dump them directly into the public markets at peak valuations. They are converting highly inflated, fragile digital equity into cold, hard cash, turning everyday retail investors into the designated bag holders of a late-stage corporate bubble. This isn't a victimless balance sheet game played by billionaires in glass penthouses. It's a trapdoor swinging open directly beneath your personal savings. The mainstream narrative maintained absolute credibility for a brief window because the corporate media weaponized the May jobs report, boasting about headline employment numbers to fuel the illusion of an unkillable economic expansion. But that narrative has officially hit a wall. When a geopolitical spark in the Strait of Hormuz triggers an aggressive supply-side energy shock, the transmission loop into your daily life is instantaneous. The cost of crude spikes, forcing commercial logistics networks to slap massive diesel fuel surcharges on every physical product moving across the domestic supply chain. Suddenly, wholesale agricultural inputs and fertilizer production plants face soaring chemical costs. By the time the chain reaction finishes ripping through the economic plumbing, the local supermarket has to aggressively jack up the price of basic consumer goods just to maintain operational survival. That is how a conflict thousands of miles away locks macro inflation into an unbreakable loop, systematically burning through the purchasing power of your supposedly strong wages. Watch the next domino slam directly into the machinery of the central bank. The Federal Reserve Chair steps into the room, reviews the internal, non-public data, and realizes he is completely cornered. If he follows through with political pressure to cut interest rates, he pours pure jet fuel onto a raging inflationary fire, destroying what remains of the domestic currency's purchasing power. But if he does what fixed income markets are now terrified he must do, unleash a surprise rate hike, he instantly spikes corporate debt servicing costs and triggers a catastrophic multiple contraction across the entire equity market. It's a luxury cruise liner taking on water in the engine room, but instead of sounding the foghorn or instructing the passengers to put on life jackets, the captain quietly walks up to the promenade deck, sets up a glittering booth, and starts selling premium raffle tickets for the limited supply of wooden lifeboats. Wall Street insiders know the ship is taking on water. They aren't trying to fix the hull. They are frantically using automated corporate trading plans to liquidate their overvalued shares into retail buy orders before the general public notices the visible tilt of the floor. How exactly do these corporate megacaps pull off a multi-billion-dollar liquidity heist without causing an immediate market panic? They weaponize the single most trusted, unquestioned tool in the modern investor's playbook: passive investing. You have been told for decades by every financial advisor, HR department, and mainstream index provider that your 401k or automated target date fund is a safe, diversified shield designed to grow your wealth automatically. In the current macroeconomic landscape, that is a lethal lie. The plumbing of the asset management industry has been quietly re-engineered to turn your passive index contributions into the ultimate toxic waste dump for overvalued corporate insider equity. See, an automated index fund does not possess a brain. It doesn't look at sticky core inflation. It doesn't care about a geopolitical energy crisis. And it certainly doesn't analyze whether a company's price-to-earnings multiple makes any logical sense. It operates purely on cold, hard digital code, snapping up shares based entirely on market capitalization weightings like an unthinking factory robot. When a mega-cap tech giant prints tens of billions of dollars in new secondary shares, the passive index funds are contractually and algorithmically obligated to deploy your automated monthly retirement contributions to buy them up. The guys holding the match also wrote the fire codes. They built an automated machine that forces your retirement capital to clear out their radioactive assets at peak valuations. While your automated portfolio is forced to swallow these freshly minted, highly diluted shares, where do you think the smart institutional money is actually migrating? When you look at the raw flow of funds behind the scenes, the reality is incredibly stark. Smart money isn't buying the tech dip. Institutional capital is quietly rotating straight out of equities and into short-duration sovereign paper, tangible commodities, and essential infrastructure plays. They are fleeing to jurisdictions where long-end yields are grinding to multi-decade highs. Just look at Japan's 30-year government bond yield violently ripping upward to 3.8% as global capital rapidly recalibrates for a higher-for-longer reality. The institutional elite are lockstepping into real yielding assets that possess structural protection, leaving passive retail accounts holding a massive basket of overvalued digital air right as the Federal Reserve prepares to pull the monetary rug out from under the entire casino. The moment that official announcement drops at the upcoming June meeting, the structural exit door welds shut for the public. Equity valuations will face a brutal, immediate contraction. Your retirement account's real purchasing power will be systematically incinerated by sticky energy inflation, and you will be left wondering how a supposedly historic economic expansion left you completely broke. The game is engineered to keep you distracted with flashing green numbers until it is mathematically too late to move out of the blast radius. If you are tired of being handled like institutional garbage and want to see the systemic dominoes before they land directly in your lap, hit the subscribe button right now. We don't do mainstream financial fairy tales here. We track the actual plumbing of the game before they change the rules on you again. Stay sharp out there.